Good evening, ladies and gentlemen, and welcome to our class on preparing for this month or next month, September 1st, non-farm payroll report, which is one of the leading economic indicators and it's the most watched and most traded economic report every month. Now, tonight's class is sponsored by ADS. ADS Securities, or ADS Prime, is a world leader as an online broker offering unequal services, support, education, and trading. They are a regulated broker that are regulated in several regulatory bodies throughout the world. So anywhere you can trade, you can find ADS Prime because they're regulated all through Europe, all through the Middle East, and through most of Asia. Now, they are one of the most respected trading platforms in the marketplace today. They've been around for a number of years. They are very well respected, and they offer a huge and broad variety of trading styles and assets you can trade. You can trade indices, currencies, commodities, shares, metals, and even treasury bonds, which is very unusual to find on a lot of platforms. So let's start to try to figure out what this non-farm payroll report is and why it sparks so much interest in the market every month. Now, the NFP, or the non-farm payroll report, is a key economic factor. Let's hold on one second. I've got some reason my screens are moving by themselves. Give me 1 second to just change something on this. I think we got it in a second here. I think we got it. Okay. There we go. The non-farm payroll report is a key economic indicator for the U.S. Now, it's a jobs report. Now, it's called the non-farm payroll report because many years ago when I was a child, in the U.S., the Department of Agriculture counted all the farms and maintained everything in. It had to do with farming. And the Board of Labor Statistics counted or reported on all the employment that was outside of the farming industry. And the Department of Labor, or the Department of Agriculture, would report on the farm jobs or the agricultural jobs. And therefore, this report got to be called the NFP, the non-farm payroll report, because it covers all the employment outside of the farming industry. It is intended to represent the total number of paid workers in the U.S. minus farm employees, government employees, private household employees, and employees of nonprofit organizations. Okay. Now, that's a lot of exceptions, but it measures the change in the number of people employed during the previous month, excluding the farming industry. A rising trend has a positive effect on the nation's currency. In other words, it's a strong report for the dollar, and it also will have an effect on the S&P, the Dow, and it traditionally has an effect on gold, because gold and the dollar usually trade in the opposite directions. Job creation is an important indicator of economic health because consumer spending, which is highly correlated to labor conditions, makes up the large portion of the GDP. This report is the first of the month that relates to labor conditions, making it susceptible to big surprises. Now, this month, the report actually comes out on the 1st of September. Okay, and it is the August jobs report because it's reporting on the employment situation for the month of August. The NFP report causes one of the consistently largest rate movements of any news announcement in the Forex market. And as a result, many analysts, traders, funds, investors, and speculators anticipate the NFP and the directional movement it will cause, With so many different parties watching this report and interpreting it, even when the number comes in line with estimates, it can cause large rate swings because lots of traders are hedging ahead of time, hedging their bets or making decisions and trading prior to the release. So some are betting the release is better, some are betting the release will be worse. So when the release comes out right on expectation, you could see a lot of market volatility because a lot of traders are caught on the wrong side of a trade. Now, trading news releases can be profitable, but it's not for the faint of heart. Now remember, risk and risk management is ultimately important. Okay. Now, this is because speculating on direction of a given currency pair upon the release can be very dangerous. Fortunately, it is possible to wait for the wild rate swings to subside. Then traders can attempt to capitalize on the real market move after the speculators have been wiped out and have taken profits and losses. The purpose of this attempt is to capture rational movement after the announcement, instead of the irrational volatility that pervades the first few minutes after an announcement. But that's up to you to decide which way you want to trade. But before we can actually trade this report, we have to fully understand it. Now, there are many different strategies, and we're going to talk later about each one of these types of strategies. But the logic behind the strategy is to wait for the markets to digest the information's significance. After initial swings have occurred and after market participants have had a bit of time to reflect on what the number means, they will enter a trade in the direction of the dominating momentum. They wait for a signal that indicates the market has chosen a direction to take the rates. This avoids getting too early and decreases the probability of being whipsawed out of the market before the market has chosen a direction. Now, because it can be so volatile, unless you can afford to cover the swing of the marketplace, and sometimes it is a huge swing. I mean, you can see the euro dollar move 100 or 200 pips. And it soar up, then fall right back down, and then soar back up and fall right, it's very, very difficult for most of us to be able to place the proper stop losses and the proper take profit points. But there are strategies that can be used. But first you have to understand exactly what the report is, what the numbers will mean when it comes out, and how to interpret them. Now, last month, the non-farms payroll report showed U.S. increased jobs by 209,000 in July of 2017. That was the report that came out this month at the beginning of August. Below an upwardly revised 231 in June, but above the market expectations of 183. So last month, we were expecting 183, and we got 209. But also, we saw an upward revision into the June report. All of that was extremely positive. Okay. So, and at the same time, the unemployment rate was at 4.3%. After declining early in the year, the unemployment rate has shown little movement in recent months. Unemployment at 4.3 is a great number for the U.S. Okay. We could see it this report in September 1st jump maybe to 4.5. Okay, 4.5 is still a good number, but a lot of times this number is a statistical anomaly. So we 4.3, 4.4, 4.5, 4.3, 4.4 up and down they're still extremely good numbers, and we don't panic because when you see what goes into those numbers and how they're crunched, you can see that sometimes it's just a mathematical calculation because each of our Thursdays unemployment numbers that come out weekly have been extremely good. So we know employment is way down employment is way up. We've created lots of jobs in the U.S. Okay. And what we look for in the U.S. is about 200,000 jobs created on per month on an annual basis. 195 isn't bad, again, on an average basis throughout the year, because the U.S. is, they've got to constantly be replacing jobs that go away. Okay. So we need some type of job creation, but since we're almost at full employment, if we continue creating this many jobs, we're going to end up having a huge opening in jobs because unemployment is falling, is way down. So we have to watch these numbers carefully. So what we want to look at is pre and post release numbers. So we want to, at this point, the only pre numbers we have are the post numbers from the August 4th release. So we actually saw the consensus deviation. This is what we were expecting. It was extremely positive. The U.S. economy added 209,000 jobs, better than the 183 that was expected. Okay. Revisions. Now, revisions, what we adjust the prior month when they've done some more calculations. We saw the June report that was released in July had an upward revision in August of 9,000 additional jobs. So that's really a push. When we had 222,000 jobs already created that month, and now we're going back and adding 9,000 jobs back into the prior month. So that's a very positive number in the August report. The unemployment rate remained neutral at 4.3 as expected. Now, what we're looking at now very, very closely are two numbers: the labor force participation rate and average hourly earnings. These are a little bit more important than the jobs right now and the unemployment rate, especially more important than the unemployment rate. We want to see how many people are participating in the jobs market. Because what happens is, especially when we came out of the bad economic cycle, we had a huge amount of people who left the jobs market. People who went back to school, housewives who just said, you know what, we're not going to work for a while. People that just gave up on looking for jobs. We want to see that they're coming back into the marketplace. So not only are we getting low unemployment, we're getting more jobs created, and we're seeing more people who just left the marketplace coming back into the marketplace. And then we also need to see, which is very important, is we need to see wage growth. Okay. Now, last month we saw an increase to 0.3% because not only do we have almost full employment, we also need to know that the people who took jobs at a lower rate are able to be moving back up to jobs at higher rates, and those people that took jobs at a lower salary are getting increases. Because if you're getting an increase in your paycheck, you're spending more money. You spend more money, you're increasing consumer spending. You increase consumer spending, you increase retail sales, which increases GDP. So we need that. This is what Japan has a terrible problem. Japan's running like a 3.2% unemployment and been all the way through their whole deflation cycle. And through all of this mess, they have huge problems because they can't get any increase in wages. The employers just won't do it. So they're at full employment, but when people don't get increased in wages, they don't spend any more money, which kills inflation because manufacturers can't charge more for goods because retailers can't sell them for more goods because it stops spending, and people don't have any increase in their paychecks. So what happens is if prices eke up a little bit, people start going backwards, and then they stop spending. So it puts a chink in this round cycle of the economy. U.S. isn't seeing that, but we want to see it continue to increase. So we saw that very well last month. Now, there are 6 major reports that come out in each monthly cycle. Okay. Each one of these reports are tied back to the labor market in some way, shape, or form. These help us predict, or these are what goes into the forecast and the consensus of what we're expecting in the next report. So if you want to start building ahead of time, now you have a week before the September report. what you want to do is you want to look at the challenger job cuts. Okay, this report comes out once a month, and because the challenger job cuts reflects companies' future plans, these tend to be more forward-looking than most economic reports. What they're looking at is companies that have said they're going to do layoffs, companies that are cut back payroll, companies that are going to be downsizing, companies that are moving offices out of the U.S. So they're predicting losses of jobs or job cuts. This is a very report. Now, they're not predicting what's going to happen, particularly in August. They're going to be predicting right now that we're going to see jobs in the next quarter cut back. That doesn't mean we're not going to have jobs growth, because one doesn't necessarily catch up with another right away. But as an NFP expert, you can take the numbers and look for a consistent pattern together with its leading indicators. For example, a large and unexpected jump in layoffs and a high reading is a bad omen for the job situation, and hence future NFP reports. So we would want to be looking at the challenger job cut that came out already in the beginning of August for helping us to look at what might be affecting the jobs number in August, but most likely down the road. So we want to be looking closer at June and July to see how those reports might be affecting the August jobs. Then we also want to look at each week. We want to take a look at the weekly, and it comes out on Thursday, initial jobless claims and continued jobless claims. Now this comes out each week, so they tend to be a little bit inaccurate, but they're reflecting each week how many people or how many employees in the U.S. have filed a first-time jobless claim in the U.S. So in other words, when you lose your job, unless, if you're quitting a job because you got another job, that's one thing. Doesn't matter, you're still employed. If you're getting laid off from your job, you're losing your job, is being cut back for some reason, in the U.S., you only get unemployment benefits if your loss of job is through no fault of your own. Now, when you lose your job, the first thing you do is you go online and you file for your unemployment checks. So this calculates how many people are making first-time claims. In other words, they just lost their job this week. And because there's a 2-week period in which you won't get unemployment benefits, most people file right away because they want to get that 2 weeks out of the way so they can collect that money. And it's entitled, in the U.S., it comes out of your paycheck. You pay into a fund out of your paycheck, and you only can collect out what you've paid in. So it's not like taking social services or anything else. Everybody who loses your job, whether you're a doctor or a clerk, you file for your unemployment. Then we have, or most people do, then we have continuing jobless claims, which makes up this number also. Continuing jobless are people that continued on unemployment. In other words, they keep filing week after week because they haven't found a job. So when you analyze this, you can then put this together to figure out where your unemployment rate would be in the U.S. So if the number of people filing for unemployment benefits increases on a sustained basis or is relatively high, it means a large number of people are losing their jobs and applying for unemployment benefits. In such a case, investors and traders will infer the economy is ailing, and the next NFP release may come out very weak. Alternatively, a decline in initial jobless claims is indicative of a healthy economy, and future NFP releases should be more positive. Now, you need to also, these jobless claims are quickly affecting them, because it's each week's. So that's going to have a direct effect on the August report, which is released the 1st of September. Now, it happens to be that our jobless claims have been very good, but a spike up for 1 or 2 weeks isn't something that the markets panic about, because you have lots of reasons. Sometimes you have a holiday coming up, so your employers will cut back jobs and lay people off right after the holidays, or there's a Monday 3-day holiday, so they're going to lay people off or get rid of those positions at the end of the week. There's seasonal things. There's things like when the students go back to school, all the summertime jobs are cut. Okay, when the companies start hiring for a Christmas holiday, and then lay off those extra workers after the Christmas holidays. So you have to, when you see the spikes, if they're continued climbs over a couple weeks in a direction, it's worrisome. But a spike here and there isn't, unless they're not expected. Then we have two other reports that are related to come out in the month also. The prior month, we have the ISM non-manufacturing, the Institute of Supply Management, non-manufacturing PMI, and the Institute of Manufacturing PMI. So we have non-manufacturing and manufacturing. PMI is Purchasing Managers Index. These are released by the Institute of Supply Management on the first business day after the reporting month. These indicators show business conditions in the U.S. non-manufacturing and manufacturing sectors. So if manufacturing conditions for last month were very good, and this is the report that would have come out August 1st, that means companies, especially manufacturing and service companies, would have been hiring throughout the month. So that will give you a very good indication to where the non-farm payroll report should be also, with creating new jobs. So this information provides a window on business plans and on what the monthly NFP number might reveal when it comes out for the reported month. Make sure you read the employment summary of the official reports to infer about the labor market conditions. Okay. But also, these reports, when they're released, have an employment part of their data. So we can see in here whether employment is growing in these sectors. And if manufacturing and services are hiring in the U.S. and employment growth is going up, that means the NFP should be extremely positive or follow the cues from the manufacturing sector. So all of this is what we have to understand, because too many people wait and they just look at what the unemployment, the non-farm payroll report number is going to be, and they have no idea where this consensus number is coming from, how they're estimated, what the markets are talking about. But you need to break down and understand the pieces that put this together. Then we have the University of Michigan's Consumer Confidence Index. It is the biggest consumer confidence report released in the U.S. Consumers are confident when their jobs are secure, and they also are seeing an increase in their wages, and there are job openings. When their friends are getting hired and their families aren't unemployed, and they're hearing about, oh, this friend got a new job here at a higher salary, and this friend got a new job, or their company has lots of openings, people feel secure. And when they feel secure, they spend, and when they spend, they help consumer spending. When they consumer spending, we help retail, and all of this goes round in a cycle. And also, all of these are important things that what the Federal Reserve is looking at when they're considering rate increases, because the U.S. Federal Reserve has a dual mandate, maintaining inflation and maintaining full employment. So even though you might have a weak non-farm payroll report, all of these pieces, you can isolate which part of pieces of this were affecting the overall employment situation. Then, the Wednesday before the non-farm payroll report comes out, we get the ADP report. And ADP stands for Automated Data Processing. It is the largest private payroll service in the U.S. Now, for many, many, many years, we use the ADP report as a consensus, as a guide of what we could expect on that Friday's non-farm payroll report. So the ADP report comes out on Wednesday, the official jobs report comes out on Friday. The ADP Employment Report is a private report. It is not a government report. But because ADP was the largest private employer, they would have access to huge amounts of data. Now, they would use this data and factor it into algorithms that the markets used to think were very accurate. Because prior to the economic crisis in the U.S., the jobs report and the ADP report and the jobs report basically moved hand in hand. When we started having this economic crisis and people were losing their jobs in all types of industries and all over the place, all of a sudden the ADP report was not accurate. It did not predict correctly the NFP. And a lot of people got worried. ADP went back and rethought their algorithms, rethought their data, and developed some new correlation between the two. Now we can see on the chart on the right here that they don't always move hand in hand, but we can see overall, if we look at the long term, we can see that they've now moved to that they're pretty accurate. So most likely when we get a solid ADP report on Wednesday, we're going to most likely get a solid NFP report on Friday. Otherwise, it could be that certain market sectors are hiring and others aren't, because ADP has, like I said, they're the biggest private payroll service, but big corporations, especially the big tech companies like Google, eBay, Amazon, they don't use outside payroll service. They have their own computers. They do everything in-house. So this data isn't available to ADP. So sometimes when there's certain sectors that are hiring, the ADP report's miscued because the ADP report could be very low, where the overall non-farms payroll report could be extremely high because it just wasn't data that the ADP employment report had access to, so they were back to using their algorithms. So you have to be aware of the possibility. It used to be that traders would basically jump in the market after Wednesday's ADP report and trade in the direction of the ADP report. So these are the things you have to sit back and analyze. And what you should be doing from now until next week is looking at them and coming up with not your consensus of how many jobs but whether you think the jobs report will be positive or negative and why. Start doing your own analysis. Now, what we do expect is we're expecting 182,000 jobs created in the month of August. Okay. That's a very, very good number if that be the case. Because August is not a hiring month. As you know, most of the world goes on vacation in August. Kids are out of school. The summer jobs haven't been cut off yet till September. There's not really people hiring because people are going away on vacation. So the hiring will start again in September. So 182,000 jobs in August is a very high number. And if it hits that number, it's a very, very good number. We can see on the chart up here that employment, we had this really bad report here. And this is why the markets sometimes freak out on a bad report. But if you were to go back and look at the consensus or the average over the April, May, June, and July, look at that. So we had a weak month because a lot of times you can explain that weak month out. Like May has Memorial Weekend. If Memorial Weekend falls early in the month, it's always the fourth Monday of the month, but sometimes it's got a fifth Monday in it. Well, people don't tend to hire before Memorial Weekend, or they do, but they'll say start June the 1st. And so sometimes all that happens is those jobs or those hirings get shifted. And in this case, that's exactly what happened. We had a late Easter, but we had lots of hiring in April, and then we had lots of new jobs in June. So May was just a statistical deviant because it just fell the way the month fell out. Now, we can see here, we have been seeing a steady increase in jobs. So we're expecting the jobs market to continue doing quite well. That means the U.S. economy is doing very, very well. Oh, my marker won't turn off here. Give me a second. And then we have our unemployment rate. And look at that. That's a beautiful downtrend. But you notice it only was at 4.9. Now we were much higher, but it's been steadily getting better. We're down at 4.3. We were at 4.5, 4.4, 4.3, back up to 4.4, down to 4.3. That's what I'm saying. Even if it jumps to 4.5 in this August report, nobody worries about it. We're on a steady positive curve. And this is still a good number. Now, overall, what we're looking at for quarter 3 is an average unemployment rate of 4.4%, a quarterly jobs offering of 165,000 payroll jobs, and 192,000 average non-farm payroll private jobs. Government payrolls were at 11.03, and manufacturing jobs were at 8.81. These are all extremely good numbers. So the non-farm payroll report is an employment report released monthly, as we talked about, that combines all of these jobs, but it doesn't include government payrolls because the non-farm payroll report is for private payrolls. So what are we expecting this month? We're expecting the consensus is about 185,000 jobs. We're expecting an average hourly work hours to remain at 34.5. Full-time employment in the U.S. is considered anywhere above 32.5 hours, but it's really 35 7-hour work days, 5 days a week. Okay. We're pretty much there that most of the labor force is being employed on, because what happened is during the bad times, lots of people were cut back. So when you're working at Walmart, they were cutting you back to 20 jobs, or Home Depot to 30. So you were keeping your job, but they were cutting back the hours you're working. So we like to see this number stay 34.5, 35, and it's very good. Unemployment rate, the consensus is 4.3. This is for the September 1 report next week. Hourly wages, we're not expecting an increase. We're expecting to stay flat at 2.5. Hourly earnings, we're hoping it stays at an increase of 0.3%. And labor participation, we have nothing coming in yet, but we hope it stays above 62.9. Now, investors consider what the labor report means for the timing of any interest rate Fed's increase. So now, what do we have? We have the big Fed meeting in September. They've been basically telegraphing we will get another rate increase. So this report will be crucially important to the final decision by Yellen and the Federal Reserve, the FOMC. Okay. A weak report could turn the Feds more dovish and put off the possibility of the rate increase, okay, till December. The other thing is, it could also, a very, very strong report, could push for that rate increase. But even a medium, if it's an extremely, extremely good report, the Feds are talking about normalizing or reducing their balance sheet. That means getting out of all that QA. We don't have any more QA, but they have to start selling that stuff back to the marketplace. Okay. They mentioned it surprisingly in the August, in the July or August comments. They're expecting to explore it a little bit more in September. If the jobs report is extremely strong, they probably will talk about it. If it's equal or a little bit weak, they will probably put that off to the December meeting. So we need to look at this report and how it's going to affect the markets, because a good jobs report becomes good for the dollar, but it can also become good for a rate increase. A rate increase isn't a very good thing for Wall Street. So we have to be careful what we're looking at on each side. Now, so how should you interpret the numbers that come out? The usual reaction of the market is that the announced number is higher than the forecast one. That is something that's good for the US dollar, and it gains ground against major currencies. This happens due to the fact that literally more dollars will be spent in the real economy, and there will be more demand for them. Stock markets and the companies that comprise their indices are also to gain from more people being employed, because the knock-on effect we mentioned are people with salaries who spend them in different sectors. If the number is weaker than forecast, we would see the opposite effect, weakening the dollar and a slump in the stock prices. For day traders, this is a good opportunity for entries in new trends that move sharper across the charts and provide more percentage or pips to trade on. However, long-term traders prefer to take into account only the hard data and prefer to steer clear of the exact moments following the announcement. Some of the best ways to trade is to trade before the announcement. Take position, watch where the markets, especially the non-farm payroll report comes out at 8:30 US time, but we're all in Europe, so we can start watching where the markets are moving before the release. Now, the stock markets aren't open yet, but gold is already trading, euro, US dollar is already trading. We can start to see where traders are taking position, and we can use that to take positions. Also, there are many strategies by using special trade executions. You could figure out where your lines of support and resistance are, set a buy order for, say, the euro US dollar and a sell order, both above the next support and resistance lines, and have one cancel the other. Or set them with long stop losses, so that, because the markets can get volatile. When the markets shoot up, it'll execute your buy order and you'll take the profit. When the market tumbles down, it'll execute your sell order, and say you have multiple positions open. And so there are many strategies you can use. Developing your strategy will take you a long time. Okay. But what we want to do is, if you're a longer term trader, we want to go in and we want to sit down and average numbers. We also want to look at the deviations exactly between the actual and the consensus. So what would you consider a surprise? In the case of a deviation, will it be sufficient to move the US dollar? Previous figure, we want to compare it to the previous number. 4, we want to be aware of any revisions and what to do when successive revisions happen. And because what happens is you could have a very good report with a downward revision which neutralizes your report, or you can have a weak report with a huge revision that pushes the market up. Okay. Again, we want to look at the unemployment rate. Okay. It's only going to make a difference if it's 4.3 and it comes in at 4.4 or 4.5 if we also had a bad jobs number. And then, like I said, we want to look at the labor participation rate. We want to look at average hourly earnings. Now, there are many different strategies you can employ. A key to news reversal strategy is patience. This is waiting for traders to digest the news release and then look for technical triggers to enter the trade. With the market volatility increasing leading into this event, it is likely volatility will continue to be high and large spikes may result in a few minutes after the release. This strategy works best for more liquid pairs, so a good starting place is a major currency like the euro US dollar or the pound US dollar. But trade it off of a 5-minute chart. You want to look at it very, very closely. Now, just minutes before the release, note that the current market price as pre-release price. This will become our entry trigger later on. After the NFP is released, wait 15 minutes. Don't get involved in that craziness of the market. Okay, so listen for the revisions. A downward revision could be negative effect on the pair. An upward revision could be positive effect. These need to be factored into the rules of Part 1. Do not trade Part 1 blindly. So here are, for this report, the 5 possible scenarios we're looking at. Okay. Within expectations, I built this range, and this range is between 178 and 187. Okay. This market will if this report comes out, and that will have very little effect on the market. So it'll be overall market neutral. Above expectations for this report should be 187 to 210. An unexpected higher reading could send the pair below one support line and would be considered market positive. Now we can have very well above expectations, and that would be at 210. The chances of such a scenario are low, but such an outcome could send the pair below a second support line. So you would have to look at the time of the release, a minute before, to see where these support and resistance lines are. You can't predict them today because we don't know where the euro US dollar or the pound US dollar, where gold will be trading, where the S&P will be trading a week from now. So you have to do this right before the report. You can't even do it 2 or 3 days before the report, because you have to build your support and resistance lines based on where the price is right prior to the release. Okay. Then below expectations would be 165 to 178. And then really below expectations could be a 165 or below. So we want to wait for the unemployment figures. This needs to be added to Part 1 and Part 2. You need to give the appropriate weight values to the revisions and the unemployment numbers and determine where you lie in Rules Part 1. It's easy when you are at the extremes. But when you are slightly above or below, it can be tricky. Now, one of the advantages of CFD trading is that you can let the traders tell you if you are in the right or wrong before you enter the market. Or you can select order entries to trade in both directions. And this is one of the important things about mastering different types of order executions. Okay. And you need to go on your platform, whoever you're trading with, or with ADS Prime, and see that they allow different types of order executions. Now, a lot of these you can do manually, but when you can set them up first in, first out, or first one cancel second, or there's lots of strategies you can use based on the types of orders that you can enter. Because first one cancels other means you can trade the euro to go up or down and set your parameters first, and then when it executes that particular order, if say the market surges up, it will cancel your other order. So when the market turns around and reverses down, it doesn't kick off the second order. Okay. Others will let you build all types of hedging strategy or straddling, but you have to know what your platform offers and allows you to do in their automated trading. And this is also one of the reasons you might want to eventually move to an MT4, MT5 platform. So remember, you have to always take into account the volatility and how the markets move. You have the knee-jerk reaction, then you'll have a market correction, and then the markets will adjust to their new levels. Okay. And you can figure some of this out ahead, but not too far ahead of the market releases. But the other way is you can watch and sit back, and you can actually watch on the price charts and see how the market starts to prepare for the NFP. Then you can see the overreaction, the market correction all the time. So maybe the first time or second time you shouldn't trade it. Or go back to last month and the month before and start learning before you do go out and trade it. Because it has a lot of volatility. It does offer trading opportunities, but you have to understand exactly what these opportunities are. You have to also develop the strategy that you're going to use. Okay. But sometimes the best way is to, like I said, wait 15 minutes, find the new level, and then trade in that direction. Or if you take a position before the market, make sure you understand where to put your stop losses and your take profit points, because you don't want to get stopped out when the volatility, what happens, I've seen it happen, where the first part of the NFP, they say, you know, you're expecting 187 and they say 165. The market tumbles against you because you thought the euro was going to, the dollar was going to go up. What happens is 45 seconds later when the revision comes out, and the revision for the prior month was up 40,000 jobs, it turned that into a very good report. But the markets are reacting very carefully. We also want to continually keep an eye on volume. And when the markets are taking position before, we can see where the volume is adjusting to the marketplace. So when you see the markets volume jumping, gold being pushed up or down, or the dollar being pushed with large volume, it can help you understand what's happening. But the fact is, to trade the immediate NFP, you need a very precise strategy, and it's more about order entry than it is about trading. Because nobody can predict where the volatility will send it to, how far it'll send up or how far it'll send it down. So you have to really understand the type of order you want to place. But now you know what to expect, how to analyze it, what we can expect this month. You can sit back and take the next week and start looking at it and start making some assessments on your own. So thank you very much for joining us tonight. There will be a recorded version of this class. You can use the same link you used to come to tonight's class. It'll be available in about 24 hours. So thank you very much. Have a great trading week, and we'll talk to you again real soon. And again, go look at Prime and take a look at all their complicated and order entries that they offer you, because that's very important. Sometimes, again, having a more advanced platform can offer you better ways to trade. Thank you, and have a great trading week. Good night now.